Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our conventional tanker market update for March 2018. Well, since the start of the year, we've seen a continuation of what we saw at the back end of 2017 in terms of rates, with very weak tanker rates across the board. In fact, tanker rates in February averaged below $10,000 per day across all segments of the tanker fleet. And that's being driven by a couple of reasons, really. I think the primary reason why rates are so low right now is just a lack of cargoes. We've seen a continuation of OPEC production cuts. And in fact, some of those countries in OPEC, especially the Middle East countries, Saudi Arabia, Kuwait, UAE, they've been cutting above and beyond their production quota. And so they've really reduced their production and reduced their exports. And what we've seen outside of the Middle East as well is some production outages from some other countries. So we had a disruption at a field in Libya last month, which took about 0.1 million barrels a day offline. And we continue to see declining supply from Venezuela. In fact, the supply drop in Venezuela is increasing at a faster rate. So we've lost about 0.3 million barrels a day of production from Venezuela just since Q4 of last year. So with those sort of planned production cuts in the Middle East and some of the unplanned outages elsewhere, it's meant a lack of cargoes, which has really impacted on the tanker market. One of the other reasons why we think the tanker market's been so weak has been we've had 2 years of high fleet growth. So we had about 6% fleet growth in 2016 and about 5% fleet growth last year. But what we also had last year was a return of ships from floating storage back into the trading fleet. So if we go back 12 months to the beginning of 2017, about 4% or just over 4% of the crude tanker fleet was being used for floating storage. Now, as the oil futures curve changed and went from contango into a backwardation, it really meant that there was no incentive to store oil on board ships. And so we saw those ships come back into the fleet. And right now, less than 1% of the crude tanker fleet is being used for storage. So that fleet growth of 5% last year, in reality, was probably more like 7 to 8% fleet growth. And a lot of those ships came in towards the back end of the year. So I think that's another reason why rates have been so weak. And then just coming into Q1, there's some normal seasonal factors at play as well. So we always have weaker demand during the first quarter of the year. And it's a time when refineries take the opportunity to do some maintenance as well. So in February and March, we've seen quite a bit of US refining capacity offline. And then the next couple of months, that will continue through to Europe and to Asia as well. So just reduced demand for crude tankers. And as I said, that's really all those factors have pushed crude tanker rates down below $10,000 a day across the board. The only place we're seeing a little bit of volatility is on the Aframaxes. We are starting to see a bit of weather delays creeping in just in the last couple of days in Europe because of the very cold weather they've had there. Return of ice conditions in the Baltic, just creating a little bit of volatility. So we're seeing some routes back to sort of $10,000 to $15,000 per day. But for the most part, rates continue to be weak. The one positive development we've seen since the start of the year has been scrapping. So tanker scrapping through 2015, 2016 was very low, about 2.5 million deadweight of scrapping. Last year we did have an uptick to about 11.5 million deadweight. And through the first 2 months of this year, we've already seen between 3 and 3.5 million deadweight of tankers scrapped. So I think we've had about 5 VLTCs and 10 Aframaxes scrapped already in the first 2 months of the year. So that's a very positive development. And if that pace of scrapping were to continue for the rest of the year, that would translate to about 18 to 20 million deadweight of scrapping. Now in our fleet forecast model, we're only factoring in about 11 to 12 million deadweight of scrapping and tanker fleet growth of about 3 to 3.5%. But if scrapping stays elevated and we get those high levels of scrapping, then fleet growth could be as low as 2% this year. And we're forecasting another 2% next year as well. So at 2% fleet growth, that's really a low level of fleet growth, and it gives the tanker market a chance to recover when the demand side improves. And that will really depend on a couple of factors. First and foremost, OPEC. So OPEC is maintaining their cuts for now. They're trying to bring down oil inventories and support oil prices. We think they'll probably maintain their cuts at least for the next 6 months. But probably as we get deeper into 2018, we are seeing that oil inventories have trended back towards 5-year average levels. We've seen the oil price at times this year hit $70 per barrel. And I think as we get into the second half of the year, as long as demand keeps growing at the current pace, we'll see a continuation of inventory drawdowns, maybe not in Q1 because it's a seasonally weak demand period, but once we get into Q2 and Q3 and certainly into Q4, I think those inventories will keep coming down. We'll probably see some more support to oil prices, and at that point OPEC might start to increase production again. In the meantime, we will continue to see an increase in US oil production growth and an increase in US exports. So US crude production a couple of months ago hit 10 million barrels a day for the first time since 1970. In fact, I think December production was a record high in terms of US crude oil production. And a lot of that surplus crude now is translating into exports. And we're seeing pretty regularly now about 1.5 million barrels a day of crude exports out of the US, at times up to 2 million barrels a day. We think by the end of the year there's scope to go up to about 2.5 million barrels a day. And a lot of that's moving either on Aframaxes and Suezmaxes and going to Latin America or to Europe, or an increasing proportion is being reverse lighted up, I should say, to a VLCC and then going long haul to Asia. So that's a positive ton-mile development. So if we bring all that together to give our view of the next few months and the next couple of years, we do think that the next 6 to 9 months will continue to be challenging for the tanker market. As long as OPEC is reining in production and we're seeing this last bit of fleet growth, then I think we can expect rates to stay fairly weak. But as we get further into 18 towards the back end of the year, I think those fundamentals do start to reach a tipping point where fleet growth comes down at the same time as demand should come back as OPEC returns supply and US exports continue to grow. So we think that late 2018 will be the recovery point for the tanker market, but really gathering pace more into 2019 and into 2020, when it could be a really volatile year in 2020 because of all the changes on the bunker fuel regulations and some of the new trade routes that could develop around that in terms of fuel oil and diesel oil needing to be moved around to meet these new regulations. So, we've got to get through this next little while, these next 6 to 9 months. But certainly when we get into 2019 and then into 2020, we think it's going to be another strong tanker market. So that's our update on the conventional tanker market, and we'll speak to you again next month.